Ever wondered how some people manage to scam billions of dollars right under everyone's nose? Today, we're diving into the murky world of financial frauds that have shocked the world. From elaborate Ponzi schemes to deceptive corporate practices, these scams highlight the lengths some will go to for money and power. Let's explore the 10 biggest financial scams in history and unravel the stories behind them. Number 10. FTX, Sam Bankman-Fried. Sam Bankman-Fried, the mastermind behind the cryptocurrency trading platform FTX, faced justice in March when he was sentenced to 25 years in prison. Found guilty of multiple fraud and conspiracy charges, including wire fraud, securities fraud, and money laundering, Bankman-Fried's downfall is one of the most significant financial fraud cases in recent history. FTX launched in May 2019, and Alameda Research, a hedge fund he co-founded, were at the center of this scandal. Bankman-Fried and other executives were accused of misusing billions in private financing to buy luxury properties, invest in ventures, and support political causes. By late 2022, the U.S. Securities and Exchange Commission revealed that he had redirected investor money from FTX to Alameda Research, leading to both entities' bankruptcy. Although FTX reported in a bankruptcy filing that most customers would get their money back, it was cold comfort to those who missed out on the crypto boom. FTX estimated debt stood at $11.2 billion. Number 9. Wirecard. In 2022, executives at Wirecard, a German electronic payments firm, were tried for what's been dubbed the biggest corporate fraud in Germany's history. CEO Markus Braun and others were accused of falsifying accounts to show 1.9 billion euros that never existed. When Wirecard declared insolvency in 2020, the fraud was exposed, and Braun was arrested while another executive, John Marsalek, fled to Russia. The trial, which could last years, has left investors with little hope of recovering their money. The scandal highlighted severe flaws in regulatory oversight and corporate governance. Number 8. Volkswagen. Volkswagen's 2015 emissions scandal, known as Dieselgate, involved the installation of software in diesel engines to cheat emissions tests. This deception resulted in nitrogen oxide emissions 40 times above legal limits. The company faced $30 billion in fines and penalties and had to recall nearly 500,000 vehicles. Since then, Volkswagen has made strides towards sustainability, focusing on electric vehicles and reducing its carbon footprint. Despite the lingering damage to its reputation, the company is gradually recovering from the scandal. Number 7. Theranos, Elizabeth Holmes. In March 2004, Elizabeth Holmes, a Stanford University dropout, founded Theranos with the promise of revolutionizing blood testing. Partnering with Ramesh Sunny Balwani, who secured a $10 million loan for the startup, Theranos was valued at $10 billion by 2014. However, the company's rapid rise was built on lies. By 2015, their blood testing device was exposed as ineffective, leading to charges of wire fraud and conspiracy. The company dissolved in 2018, and Holmes and Balwani were sentenced to 11 and 12 years in prison, respectively, in late 2022. Additionally, they were ordered to pay $452 million in restitution. Holmes reported to a minimum security prison in 2023, and in a final blow, she was banned from federal health programs for 90 years. Number 6. Luckin Coffee. Once poised to challenge Starbucks in China, Luckin Coffee was rocked by a scandal in 2020 when it was revealed that the company had fabricated $310 million in sales. This led to its delisting from NASDAQ and significant financial losses. However, under new management, Luckin Coffee has made a remarkable comeback. It's now the largest coffee retailer in China, with substantial revenue growth and an expanding customer base. The company's turnaround is a rare positive outcome following such a major scandal. Number 5. Enron. Enron, once hailed as America's most innovative company, collapsed in 2001 after it was revealed that the energy giant had been using accounting loopholes and special-purpose entities to hide massive debts. This deception led to one of the largest bankruptcies in U.S. history and the loss of thousands of jobs and billions in pension funds. The Enron scandal prompted the enactment of the Sarbanes-Oxley Act in 2002, which aimed to improve corporate governance and accountability. The scandal remains a powerful example of corporate malfeasance and its devastating effects. Number 4. Wells Fargo. Wells Fargo's reputation has been marred by multiple scandals, the most notable being the fake account scandal of 2016. Overworked employees, pressured by unrealistic sales targets, opened approximately 2 million unauthorized accounts to meet quotas. This led to a $3 billion fine by the SEC and additional penalties by the Consumer Financial Protection Bureau. Despite attempts to reform, Wells Fargo continues to face legal challenges. In 2023, they settled a class action lawsuit for $1 billion and paid $3.7 billion for various other illegal activities. The bank's ongoing issues highlight the persistent problems within its corporate culture. Number 3. Ivan Boesky. Ivan Boesky, a notorious Wall Street trader of the 1980s, earned the moniker Ivan the Terrible for his role in insider trading. Boesky made over $200 million by illegally profiting from corporate takeovers and mergers using insider information. His activities led to his arrest in 1985, and a year later, he was found guilty. Boesky cooperated with investigators, helping to implicate others, including Michael Milken. He was sentenced to 3.5 years in prison, fined $100 million, and barred from the securities industry. Boesky's actions and subsequent punishment partially inspired the character Gordon Gekko in the film Wall Street. Number 2. Bernie Madoff. Bernie Madoff orchestrated the largest Ponzi scheme in history, defrauding investors of over $19 billion. A former chair of NASDAQ and Wall Street legend, Madoff used his reputation to lure thousands into his scheme, promising high returns through non-existent stock trades and fabricated brokerage accounts. The scheme unraveled during the 2008 financial crisis, leading to Madoff's arrest. In 2009, he was sentenced to 150 years in prison for 11 counts of fraud. Madoff's story was further brought to light by the 2023 Netflix documentary, The Monster of Wall Street. This scandal serves as a stark reminder of the devastating impact of financial deceit and the importance of regulatory oversight in protecting investors from fraudulent schemes. Number 1. WorldCom. Bernard Ebbers. Bernard Ebbers, CEO of WorldCom, masterminded one of the most infamous corporate scandals in history. Under his leadership, WorldCom engaged in an elaborate scheme to inflate profits by billions through fraudulent accounting practices, hiding expenses, and inflating revenues. The scandal came to light in 2002, leading to WorldCom's bankruptcy, one of the largest in history at the time. Ebbers was sentenced to 25 years in prison in 2005 for securities fraud, conspiracy, and filing false statements. His actions highlighted the destructive power of corporate greed, affecting investors, employees, and the financial markets. The WorldCom scandal underscores the critical need for transparency and accountability in corporate governance to prevent such catastrophic financial deceit. These 10 financial scams serve as a sobering reminder of the potential for deceit in the world of finance. They highlight the importance of regulatory oversight, corporate governance, and ethical behavior in maintaining the integrity of financial markets. While some of these companies and individuals have faced justice, the impacts of their actions continue to be felt by investors and the broader economy. If you found this video informative, then don't forget to hit that like button and subscribe to our channel for more amazing content. Thanks for watching, and we will see you in our next video.